Good afternoon, friends, and welcome. I'll be sharing live trades and results with you. We'll be evaluating how well these trades work out. We'll be benchmarking this against the S&P 500. I'm expecting to be outperforming it every month. Along the way, I'll also be sharing some lessons I've learned about investments, trading, and building wealth. And of course, the mandatory disclaimer. This is for educational and entertainment purposes only. It should not be interpreted as advice. And with that, let's get into it. Well, welcome to 2026. What a crazy looking chart. So right around here is the end of the year. I guess a little bit further out, maybe in here somewhere. But if you look from here to, which is now, today's February 23rd, I don't know what to make of this chart. It's going up, it's going down, it's all over the place. We've had 10 trades so far this year. We started last year in one of our trades and it took us partway through it. But that trade finished up with some profit. So that turned out to be a good trade. And you can see each trade here and how it was made. Adam's been navigating this pretty well. I mean, we exited at the end of this day. You know, the market took a big drop the following day. Adam was very in sync with that. And the whole idea of this strategy is, try and capture some profit, try and time the market when you think there's going to be a drop, and try and capitalize on it. And you can see in this case, it did pretty well. The market rebounded and Adam took an exit. In some ways, that was a little bit too early. If he would let it run, he could have made twice as much. But we took the exit there. We got back in on the following day and, took an exit the next day after. So we're trading pretty fast. We've got 10 trades into 2026, and as I said, it's February 23rd. So, profitable trade, another profitable. Here's a couple losses. Here's us trying to get back in, and a good example of where we're not doing a good job. We don't like buying it at a higher market for one thing, but if it's going to run, it works out okay. But in this case, it didn't. So one day loss, we took an exit. Was it too early? I don't know. It actually looks like a pretty decent exit. Next day, the market drops. It'd have been great to have a repeat, but the market dropped. We got back in. We thought it was going to run a little bit, which it did the day after we made the entry. But the next day, it's taking a big loss. Do we get out there? Well, we did at this point. And that probably was a good exit as well because we were avoiding a down period. Here's another case where we're buying in a little bit lower, which is great, but the market, again, falls even lower. We stayed in for another day and took our exit here. We're trying to get some sort of a rebound there, and that's probably a good thing. The market takes off. We could have held in a little bit longer and gotten a little bit more out of it, but we didn't. We exited here. We made an entry here and we took an exit. The market was just, falling again. This has been a very dynamic market. We were able to buy back in here, although this was a funny thing. After this day, the aftermarket trading took our entry price way into here. So we actually ended up taking a little bit bigger loss than we had hoped to. This could have been a little flat or positive, but as you know, sometimes we don't always get the perfect pricing, which is what happened there. And we turned sort of a flat trade into a little bit of a loser. Bought back in here, took an exit, took a little win there. Market fell, we bought back in, and we took our last exit on last Friday. And that's where we're at. We took our exit there. This is Monday the 23rd. The S&P is slipping, which is really great. It'll be interesting to see what happens in our next trade, but it's likely if this fall continues to happen, we're likely to go back in because, again, we like buying lower than we sold. We like selling for a profit, and we don't necessarily want to buy in at a higher price. But if we think the market's going to run, sometimes that's exactly what we do. So let's head over to our tracking sheet and see how these trades are going so far this year. Well, as I mentioned, we have about 10 trades here to catch up on. And this is how things are kind of shaping up. I probably won't go through in a ton of detail other than just sort of noting that our first trade for the year closed on January 16th. We had actually held that for some period of time. The market definitely came up. We were definitely coming up on in terms of the leverage position. So for those who haven't been following for a while, we are trading a leveraged version of this S&P 500. It's called SSO. So it's a 2x leveraged amount. So what that means is if the market goes down 1%, we go down 2%. If the market goes up 1%, we go up 2%. So a little bit tricky to navigate, but as you saw on our chart, sometimes it does extremely well. On the 21st here, the market had actually dropped from its prior position, from where we closed prior, but because we were able to buy it when the market came down, we definitely picked up 2.36%. These are by far my most favorite trades. You know, when you're making money in a falling market, I think that's the holy grail. But we were able to do that time. We aren't always able to do it, but that's one that worked out well. You know, there's other times where the market's going up and we're taking losses. Sometimes that happens. It particularly happened when we're buying in at a higher price. The market's already gone up, and then there's some pullback, and we take twice that pullback. So it does happen on occasion. Here's one where we're taking about the same kind of loss. Very typically, we've bought in at a lower market, but because we're two times the market on any kind of a drop, we may actually take a little bit bigger loss. But you can see, you know, sometimes the leverage fund is working for us. Sometimes it's not. You know, on the 29th, it was not. On the 6th of February, you know, the market was up slightly from our prior exit, 0.16, but we're up, you know, 1.3 plus. So we're slowly trying to gain here on the markets. Our winning trades are outpacing our losing trades. We can check our metrics to sort of see where we're at with those, but I can just eyeball this and see, you know, our winning trades, the size of them are larger. So where we ended up on the 20th was that, you know, the S&P was 689, year to date 1.1%. Now it's off to a start. You saw from those charts, they were just all over the place. I can't even imagine what's going to happen over the next couple of days or so. This is Monday the 23rd. This is over the weekend where there was some new tariff activity. I'm sure that's influencing the market. Where we ended up on our last trade, we took about 1.3% gain. That brings our year-to-date number to 6.45%. It also means our beat the market factor is we're doing about 5 times better than the market at this point. I don't want to get, you know, too over the skis here. It's great to be ahead, but if the market starts tanking and we start tanking, we will tank twice as fast. So always a little bit challenging on that. You know, I'm going to come back down here to our metrics. These are pretty key for us. We're only running at about a 50% win rate, which is interesting, and we expect that to be about 70%, where it is where we are about typically. You can see historically 68, 65, 60. You know, we're underperforming in some of those years, but we are definitely even below those. Beat the market factor, we're just trying to get about 1.5 times the market, meaning if the market goes up 10%, we'd like to go up 15%. Anytime we're sort of outpacing, it's really good. You can see our historical numbers are really good. You know, generally we're beating that benchmark, and that's sort of an important one. For every dollar that's being invested, the market will give you $1 and we'll get $1.50. So another couple of key metrics, you know, maybe I'll just focus on sort of the 3 that I tend to watch a lot, is we've been doing this now 1, 2, 3, 4, 5. This is our 6th year of tracking this. The compound annual growth rate for buying and holding the S&P 500, including all the dividends, all in is about 14.36. One thing that makes me think about is, you know, for the last 6 years, the market is outperforming, I think, historical averages more like 7, 8%. So we've got an interesting market. You know, some people are talking about, is it overbought or what's going to happen? I can't tell you that, but it's sort of interesting to see. You know, we're definitely having higher returns in these 6 years than maybe 20 years prior to that. And even those were good years. So 14.36 in the S&P 500. We're tracking at about 22.57% compounding annual growth rate. That's a pretty solid response, a pretty good solid result. The drawdown for this year only, S&P biggest drawdown was 1.8%. Drawdown again is I'm looking at the highest peak. It doesn't matter what day it occurs on, but from the highest peak to the recovery, 1.8%. And you can probably see that if you remember the chart, how it was sort of vacillating around the same set of numbers. Atom actually does a little bit better on the drawdown side, 1.48, so pretty good. Volatility is higher with Atom, but most of that's upside volatility. So almost 1% higher on upside. But I think at this point, the things that sort of matter to me the most are these things right here. What's the drawdown? What's the compound annual growth rate? And to me, I can infer like how bad is bad going to be and what does the upside look like. So, going back to our 6-year chart, you can see where we're at right now this year as of toward the end of February, 6.45% for our trading, 1.1% for buy and hold. It's going to be a very interesting 2026. There's lots of volatility in the market. There are lots of speculations as to what's going to happen. The only way that we're going to know is we'll have to check back in next time. That's it for today. How do you think we're doing? Please comment below and let me know how this compares to other investments you've seen. This is for entertainment and educational purposes only and should not be taken or interpreted as advice. Until next time.